Hi, everyone. Leah Slaughter. Hope you are doing great. Glad to be here today. I am so sorry I had to reschedule last week. For those of you who don't know, my grandfather died. And so last week was a bit of a whirlwind for me, but appreciate your patience with rescheduling for today. We are very excited to talk today about cost segregation. It's a question that I get a lot, and a lot of what comes to me is, well, how does this benefit me if I only have a few properties? Or how does it benefit me as a small time investor? And so, as I mentioned a couple of months ago when we scheduled this class, one of the things I want to focus on today is how each and every property that you put through a cost segregation makes a significant impacts in multiple ways. And so we're super blessed to have two great guests here today, and I'm going to introduce both of them to you in just a minute. But before that, let's go through a couple housekeeping items. So first, we've got a class on March 23rd. And this is going to cover the entities and the ways in which we buy rental property. I get this question all the time. Should I buy it in an LLC? Should I do it in my personal name? How does that affect financing? We are going to look at all the different pieces of titling companies and really how the way that you purchase real estate not only affects the financing, but affects the liability side. Now, of course, those of you who know me are thinking, oh, liability side, is there going to be a lawyer on? So, of course, we're going to have a few different perspectives, and I look forward to getting to show you both sides of kind of that coin, because there's a lot of benefits of keeping things in your personal name, and there's a lot of benefits of putting it in an LLC. Now, obviously, when you get to my level, there's no longer a question involved. We're not going to go buy property in a personal name. But when you're just starting out, and especially when you're looking at conventional lending, this is a question and a weight that we really have to look at. And one of the things that I want to focus on and that I want to talk to you about is, with the rising interest rate climate, how there's really not a significant difference between commercial portfolio lending rates and Fannie Mae rates. Now, those of you that have been listening to me for years, you've heard me talk about this a lot, that when interest rates go high, generally conventional lending becomes less appealing. Now, in my mind, it's already less appealing anyway, especially as we exited COVID and all of the government controls that went into play with backed mortgages, but that's a whole different story. So we're going to cover the whole gambit on this. This is probably going to be an hour class because there's a lot of pieces I want to talk about, but this is definitely one not to miss. Now, remember, when you register for one of these webinars, you're automatically going to get a link to watch it on the back end. So if you can't attend it live, you can go back and watch it with that link, or to rewatch it. And then, of course, it goes on all of our podcast channels, YouTube, Facebook, all of that. So again, you can go to Twitter, Facebook, Instagram, YouTube, any of our podcast channels to go watch these classes again in the future. Of course, you can go to Facebook to see upcoming events and to register for upcoming classes. And then also you can go to our website under media and find all of our previous classes. We generally keep about 2 years worth of classes on there. But if there's one that was previously on there that you want to go back and take a look at, you can always reach out. We often have the archives of those as well. Before we get started, of course, as always, everything that we're going to talk about today is my best guess, my best judgment based on years of experience, not only owning and operating a real estate investment management firm, but also being a high volume investor myself. We're lucky enough to have two guests with us here today that are also going to give you an insight into their knowledge and their experience level. But none of our guidance is legal advice. None of it is tax advice, and it does not create a relationship for that type of guidance. We are one tool in your toolbox, as are our other guests today. If you have any specific questions relating to your particular tax or real estate investment journey, you can always reach out to us directly. And if we can't assist you, we will recommend or guide you to the people that are other members who can assist you with that journey. Of course, all of this is to say we have no crystal ball. There's no guarantees in real estate, and all real estate and investment in general is subject to risk. So please make sure you do your research, make sure you ask questions, and make sure you have a wonderful team. At the end of the day, this is a team sport. We are all on the same side, and we are all in this following the model together. We encourage you to ask questions along the way, and I will address those as we move forward through the webinar today, and then we'll also do a Q&A at the end with all three of us. So without further ado, first, let me introduce Howard Goodman. I can't say enough positive about you, Howard. You have changed my life. I know you have changed the life of so many of our customers, but more importantly, it is truly just it's a blessing every time we get to work for you. You are honest and you are positive and you are knowledgeable and you just make things so easy. And I know how busy you are, so I really appreciate you taking the time to come on with me today.
Thanks very much, Leah. I appreciate the introduction, and I just want to say very briefly that I've obviously been working with you for a number of years, and I've also been working with your other guests from KBKG for a number of years. The cost segregation is a fantastic strategy. It's actually much simpler to understand than one might think. And again, I just truly enjoy helping all real estate investors just get more bang for their buck.
Exactly. So just give me a brief little overview for our guests about who you are and what your experience is.
Yeah, sure. So I've been a certified public accountant for a little over 30 years now, originally from New York, but I've been here in the Texas area for 20 years. As the slide mentions, I went to the Wharton School of Business and graduated with a degree in accounting. The first half of my career, I actually spent in investment banking with some of the bigger names, Lehman Brothers, Salomon Brothers, Citibank, as an internal auditor and on the operations side. And then about 10 or 15 years ago, I started my own firm and do everything from tax to bookkeeping to fractional controller services. And I do pretty much much of that with OmniKey. I really enjoy working with real estate investors, and that's sort of become a niche for me over the years I've been working with OmniKey. So I've learned quite a bit just in preparing taxes, what it means for a real estate investor to get all the deductions they need, making sure they, give me all of the HUD statements with all the closing costs, their property taxes, the mortgage interest, and everything that not everyone always thinks about, writing off cell phones for your real estate business, your car travel to visit the properties, et cetera. So I love helping people get as many deductions as they can. And again, cost segregation, I've really delved into this specifically in the last 2 or 3 years. I've actually worked with Leah on a large one in particular, and I've been doing that for several clients now. And it's just a really, really great way to reduce your tax liability in the near term.
Yeah, one thing I always talk about when we do these webinars and when speaking with our customers and just, colleagues in the industry, this is very much a family affair, right? So we pride ourselves on being family owned and operated. And Howard, you run your business the same way. And for me, it's very important that the people I bring to you and the people that I put in front of you, all of our customers and our friends and our colleagues, are people that I trust and that I use for my own investment journey. And so I'm very confident in saying I am probably your most complicated client. I don't think there's
I believe so. I believe so.
But really, it's a joy to be able to bring people that we've had that great success with and who have made our path possible and be able to bring that back to all of you guys. And the one thing I want to repeat, because I don't say it a lot anymore, I used to say it a lot. I feel like people know our integrity and I don't have to do it anymore. But all of these people that we refer to you, there's no kickbacks, there's no referral fees, there's no discounts. We get absolutely nothing for bringing you these contacts. We actually, in our state, if we're going to make money on a referral, we have to have you sign an agreement that you understand we're getting paid, which of course we don't do. So I say that to say, when we bring guests on here and when we tell you we've had a great experience with someone, we quite literally have no financial stake in that. We only do it because they do a good job. And that is why we bring you our team, not just people in the industry. So Howard, again, thank you so much for being here. We are also very excited today to have Winston with us from KBKG. As Howard alluded to, I do use KBKG for my cost segregation studies. I think they did something like maybe 40 properties for me last year. I think we're in the midst of, Howard, what are we doing? Another 50 about to start, something like that?
That's about right.
Yeah, sounds about right. So I obviously believe in what they do, and the tax savings that I have realized is massive, absolutely massive. I've used them for single family, I've used them for commercial, and I've used them for multifamily I own. So I have been infinitely impressed. They made the process extremely easy, very little documentation. And for me, because I follow the same model on everything that I do, I'm extremely consistent in my finish out and my pricing and my areas and just everything that we do. You guys really made it just so easy. So Winston, thank you for joining us. I know that y'all are busy, especially right now as we approach tax time.
Yes, that's very true. We appreciate Appreciate being on for sure.
So tell me a little bit about you and your position with KBKG, and then we'll get started going through why we're all here.
Right, yeah. So I graduated from the Georgia Institute of Technology as an engineer. So KBKG, we really value engineering perspective to get these studies done, since we're analyzing property and the different components of each property. But have been doing this essentially since 2003. So I actually have a little bit more than 12 years experience. But I am a certified cost segregation professional. That's the industry standard for our industry. And there's not a whole lot of us out here, but KBKG does have more certified cost seg professionals than any other firm. So we're a great firm to work with. Like, I've been doing this a long time, like she's saying, and we do have special software geared towards single family residences. We'll talk about that a little later, but definitely, you know, whether it's high value or high dollar properties or low dollar properties, I don't want to say low, but you know, but essentially there's ways of getting additional tax deductions no matter what kind of property you have, I guess is the best way of saying it. And
yeah. You guys
right
have
now,
done properties for us anywhere from, I'd say, a 90,000 value back before, you know, kind of went through the roof, all the way up to a couple million. So we've used you for a wide array of price points.
correct, yeah. And we can go ahead and get into the presentation.
Perfect. So let's get started. A lot of our clients don't know what cost segregation is, especially those that have just bought their first property or their first couple properties. So let's start with just a basic overview of what a cost segregation study is, and then we can talk about how and why we use them.
Correct, yeah. So cost segregation studies, essentially you buy property, and when you buy the property, a certain percentage of your acquisition will go to land, but the rest of it is either the building or the improvements to the land, like your parking lot. And so you can be taking depreciation deductions on your property, right? Generally, without a cost segregation study, you're going to be depreciating things over a 39-year life, or in the case of residential rental property, over a 27.5-year life. And so essentially you get depreciation deductions year by year for 27.5 years. Well, with a cost segregation study, like the slide says, we come in and analyze the assets that should get 5, 7, or 15-year asset class life. And so you can depreciate those assets faster and get your deductions sooner, right? So that's moving this next slide. That is the goal of the cost segregation study. It's looking at your property, identifying which assets can be depreciated over 5, 7, or 15-year class life. When you think about that, generally you're looking at maybe the carpet or special purpose plumbing like a kitchen sink. There's all different kinds of assets that would have a 5-year life. And then the 15-year life items are the parking lot and the sidewalk. So we do an engineering-based study to tell you what assets you get that are 5, 7, and 15 years, right? So even if you buy a $200,000 home, right now there's 100% bonus depreciation. That essentially means you get all of those deductions from 5 and 15-year assets in year one, in the first year. Instead of waiting 5 years or 15 years, you get them in year one. So you can imagine that would indeed increase your tax deductions, which increase your cash flow. The whole idea is the time value of money, especially now with inflation going on. Instead of waiting 30 years for your deductions, depreciation deductions, you can go ahead and get a huge chunk of them, maybe 20 to 40%, probably 20 to 30% in general, of your total basis, get it in year one under current tax law. So that's the main goal of a cost segregation study. The secondary goal is to establish the depreciable basis for certain components that you might retire later. This could be the roof. You know, maybe in the future you're going to replace the windows, doors, HVAC systems. So it allows you to take additional retirement loss on these assets in later years, which is also additional deductions. So those are generally the two main goals.
Yeah, Winston, if you don't mind, I'd like to make a comment about the taxes, if I may.
Go ahead.
The bonus depreciation that you were talking about, that law was initiated several years ago. And 2022 is the last year that you'll be able to take 100% bonus depreciation. Over the next 5 years, that's going to be reduced 20% a year to 80%, 60, 40, et cetera. So again, the idea of the cost segregation is instead of, let's say, depreciating over 27.5 years, there are certain things you could depreciate over 5 or 15, which current law, the bonus depreciation allows you to do all at once. But in future years, it will be only 80% of the value and then 60% of the value. So this year is the last year so far, unless they change the law, you could take all 100% of those items as depreciation in year 1.
And you have to remember right now, the political climate is such that they're really coming after the real estate investor. You know, if they could really get it passed to end 1031s, they would. They can't. You know, most of Congress makes their money in real estate, but we are targets, all of us, because we are. It kind of started when all of Trump's real estate dealings got on the news. And this isn't a left or right issue. This is just they equate investing with the rich. And so what's happened is there's been a lot of just stigma against real estate deals for about the last 5-6 years. And so I don't know what's going to happen long term with this, but what we do know is a few things. So like in my case, for example, my year 1 bonus depreciation of the study we did last year, Howard, it was about 30% that it wound up being that was an instant deduction. I think when I did the math, it was
Yep.
like 30, 32%, something like that.
Yes, and that's
So
pretty standard for residential, yeah.
yep. So when we're talking about a $150,000 property, to put that into perspective, you're talking a $45,000 depreciable item for that one property year 1. And then remember, that's only, let's say, 30% of the value of the property. So you still have 70% of your segregation amount that continues. And so it's not like you're taking all of your depreciation year 1. And so me, for example, a lot of the reasons that I did cost segregation are really quite simple. Number one, we're in a higher rate climate in terms of the income tax rate that people owe. And I think that especially based on the speech last night of a lot of things that they're going to try to accomplish in the next year, I think it's extremely reasonable to feel that the income tax rates are going to go higher. Do you both agree?
No, they're not going down, I can tell you that.
That's a good way of putting it.
In addition to that, the value of the dollar and with inflation means that the money that you save now and that you depreciate now is going to hold more value today than say in 10 years or 15 years or 20 years. And I think it's happening at a much faster rate than many of us expected. So I think that from a just fiscal perspective, there's a lot of reasons to be cost segregating today. In addition to that, with the bonus depreciation piece, we don't know what could change next year. We don't know if they could decide that they want to quickly escalate some of these things to disappear or to change. And so it's kind of like that old saying, take what you got when the giving's good. And that's really the mentality that I and most of my colleagues have adopted as it pertains to cost segregation. So to put it into perspective, this year I have put and am putting 100% of the properties I have not yet segregated into cost segregation studies. So in terms of my personal opinion, I think that speaks pretty strongly.
I would add that bonus depreciation tends to not be a divisive issue, whether Republican or Democrat. It's pretty popular. So, you know, we see that they may, I mean, Howard is totally right about how it's phasing down, but there's always the chance that they decide to bump it back up in future years as well. So
Yeah.
It's not an unpopular thing. Whereas 1031 exchanges are definitely more have been attacked by the Biden administration more than bonus has.
Yeah, I think the big thing to keep in mind right now is, again, a lot of Congress is in real estate, and this is how they save on their taxes too. And so of the battles that we're going to see from either side, I don't think this is going to be the top of the list.
Okay.
So let's talk about the benefits of cost segregation, because as I mentioned, there's a lot of them, but let's talk about kind of the 3 key ones here.
Right, yeah. I mean, essentially you've stated the increase in cash flow. These are deductions, so it depends on your tax bracket as well. That's why we always want to work with your CPAs, your accountants, those who know your tax situation. Make sure, you know, you need the deductions, and then the higher bracket, tax bracket, and the more cash flow it's going to generate for you. Um, so essentially, I don't know if you also want to move to the example slide, but and we've already talked about this, that essentially that what does a cost segregation study do? It takes either 39-year asset or 27.5-year asset and moves it to these other 5, 7, 15, allows for other retirements of HVAC, ceiling, floors, that sort of thing. Also, we have a slide later about qualified improvement property, but if the residential rental property you have is short-term rental property, the negative would be it puts you in a 39-year life. The positive is any improvements you do to that property that are inside the structure are likely eligible for qualified improvement property, and immediately, you know, that's a 15-year class life and 100% bonus eligible currently. So essentially, it's a great, huge tax deduction. If for some reason you want to buy a short-term rental property and then place it in service and then improve it after the fact, you can get some pretty substantial deductions from the improvements you do to that short-term rental property, but it's only available for short-term rental. It's like a beach house. Another kind of insight into and essentially acquiring short-term rentals. But cost segregation studies essentially see this, when do they make sense? And because of the bonus depreciation, you know, we've done studies, you know, as low as, you know, $200,000 or $300,000. To do a full-blown study, they tend to be, you know, probably at least $1 million or $750,000. Definitely acquired in the last 20 years because you can do look-back studies, right? And here's that example we were talking about. Now here we have the example of an office building, but the same could be said for a residential rental property, right? $5 million, if it was residential rental, it'd be 27.5 years, not 39-year life, but still recovering over a certain amount over 5 and 15 years, right? So in general, she talked about that 30% amount, right? So in this particular case, looking at $750,000, $750,000 in 5-year property, $500,000 in 15-year property. And on this $5 million property, you know, you're looking at increased first 5-year deductions about $1 million, right? So that's true. Now, if you're doing it's kind of a scale thing. So if you're doing maybe $1 million property, you know, maybe that's $200,000, $300,000 of tax deductions over those first 5 years. So there's kind of a scaling factor to it. You can think about what is your property and what kind of deductions might you generate. So Howard, Leah, do you want to add anything in here?
Yeah, I
No.
just want to mention something so that, you know, not everybody thinks, you know, that they're getting all cash back in their pocket necessarily, although that's the goal. And if you're a certain type of taxpayer, you can. So, you know, for example, if you are what is considered a real estate investor by the IRS because you're spending a significant time in your real estate investments, you can basically write off all of this depreciation against your income and basically have no tax bill. And any excess loss that you have can be carried forward to future years, which is really, really wonderful. There is also a provision that if you are not considered a real estate investor, maybe you just have a handful of properties, but your income is not that high, maybe it's in up to the low to mid 6 figures, you're still allowed to use $25,000 of the loss against any other income you have like W-2 or whatnot. So I just want to say that those type of people are the ones that will benefit the most. Even if you are not any of that, you will still get to carry forward losses, even if you can't, quote, save taxes and have the cash in your pocket this year. Those carry forward losses will go on your taxes indefinitely until such time as you sell the property outright, and then you'll be able to write all of it off at the time of sale. So I just wanted to clarify that.
Yeah, and what Howard said is really important. That's why you want to have a CPA who understands your situation, understands, if you need the deductions, and making that determination. Are you a real estate professional? Is your activity passive or active income? And do these losses, you can't have passive losses offsetting
Right.
active income.
And so there's no question that there's a benefit. It's just depending on who you are and what your situation is, the benefit will be immediate or will be in the future. But there's no doubt the benefit is the same, either way. And in fact, as you build your portfolio and perhaps you have more income and you go into a higher tax bracket, if you're carrying it forward and you can't use it now, when you do get to take it, you'll get much more of a benefit in the future when your tax bracket is higher.
So I've got two questions I think we can go ahead and address. Number one is, can you do this for a condo unit?
Yes. Yeah, as long as it's, generating income.
Okay, and they've got some follow-ups. Is it too late to do a study for 2022 to take advantage of the 100% bonus depreciation if the tax returns are due April 15th?
Well, your 2020 would be due April 15th of 2023, so you have plenty of time.
And if it was for last year is what they meant, meaning that the filing in 22/4/21.
Yeah, there's still time. The software KBKG has, if it's in that threshold, then you can get the study done very quickly.
Right, and of course you can extend your tax return until October. You can extend the filing. And if you believe you're not going to have to owe any taxes, then you won't have to pay in April. The theory is whether you extend the filing until October, you still owe your tax in April. But if you believe you're going to have a significant deduction because of the cost segregation study or even deferring the entire tax burden, just don't pay in April and you file in October. So you have plenty of time.
And then when you say basis, is it cost of purchase excluding land value? Or how do you determine your basis?
Correct. Yeah, you would not include the land value. You can't take any depreciation deductions on land.
Perfect. Those were the questions. Anything else on this slide we want to cover before we move on, gentlemen?
I think we already looked essentially at these ideas. So.
Okay. So let's talk about kind of how you all work for the smaller residential properties.
Right. So KBKG has this software which you can go. If you go on YouTube, there's like a 13-minute video, or maybe it's only 10 minutes, just to watch how easy it is to input your data and essentially get your cost segregation results. This is only for residential rental properties. We don't have anything at this time for office properties. It's only for a basis amount less than $500,000. The software and the formulas, algorithms used are for the specific data set. And so if it's above that amount, we recommend doing a fuller study. But essentially, it's a pretty easy way of finding your deductions quickly, and it's pretty self-explanatory. We do have a webinar that goes through how to do it. If people have questions. So, anyways, people found this to be a very useful tool. We have a lot of clients that love the software. I don't know what else there is to add, but.
Yeah, I definitely think that it's very simple. So essentially the piece you've got to understand is there's more than one way to do a cost segregation. And correct me if I'm wrong, but it's essentially about how easily defendable it is and how detailed it goes.
Yeah, that is correct. Yeah, so this software is a frugal solution for coming up with a methodology to apply and get your 5 and 15-year assets broken out from your 27.5-year assets. But I mean, it's one that we stand behind and feel really good about. But we recommend, the increase of being audited is on these higher dollar amounts, and so we want to make sure that we fine tune and make sure that a reasonable engineering method is used for these higher dollar amounts. So that's why a fuller study is recommended.
Winston, if I can ask a quick question about the residential cost segregator.
Sure.
I've seen it, I've been online, I'm familiar with it. Basically, my clients, I give them a few options and I say, you can go in there and do it yourself. The questions are pretty straightforward. or they could have me do it for them and I sort of act as an intermediary. But what kind of support is there if someone just decides to go right to the KBKG website, if they have a question, about one of the questions, they don't know how to answer it? Is there a phone number to call or something for them?
No, essentially, it's nice to know someone like myself. You're welcome to email. So I have dialogue with clients in the past about just answering questions about what they have through the software. Most of it is pretty self-explanatory, and the other questions are pretty easily answered. So, just have my email, and you're welcome to email me, and I can either answer it or pass it to someone on my team that can answer for me.
Thank you.
So we have a question. Is this applicable on a primary residence? And if not, why?
The answer to that would be no, it's not applicable. This is for assets, generating income as a business. Howard could probably maybe explain a little better than that, but the long and short of it, it's you're not an asset. We have done it on primary residences that maybe part of the home is being used for a business purpose. Like we have one client that maybe they turned the garage into a salon, and so they're using it for their business. But essentially, you have to follow certain rules that would qualify that portion here is not for personal use any longer. It's now for your business.
Perfect. And let's move on. I've got a couple more questions here, but some of these are going to be addressed in a future slide. So Roy and Edward, give us just a few minutes and we're going to answer that for you. So when do you recommend doing the cost segregation study on these properties?
Whenever you need the deductions. I mean, that's probably the long and short of it. Yeah, I mean, we always want to work with CPAs. We want this to make sense for you. I always say I don't want to tell you something you don't need. But essentially, acquisitions, new construction, improvements, all these are often very good at generating deductions. So it's just when do you need those deductions? You could have a property and have owned it for several years. We can go and do a look back study if you hadn't need the deductions yet. So that is do that. We do get that question, like if I don't need the deductions now, should I go ahead and do the study? And I tend to say I would wait personally. Some people want to do it just to go ahead and establish the land value and have that discussion with our team. But other than that, I tend to encourage people to wait till you need the deductions.
Perfect. So let's talk about what's involved. What type of information are they providing?
In order to get the study done, yes, yeah. So a good quality cost segregation study would want to have good pictures of the property. And so that's why an inspection is often used to make sure we have a good understanding of what's at the space. You might ask for an appraisal. If you have engineering drawings of the property, that's always helpful, or an Alta survey. We might ask a few other questions about, how much, if you're improving the property, how much money are you spending on the improvements? And then we also work with you to establish the land value. We don't, as KBKG, we would never tell you what land value to use. Even if you don't have a cost segregation study, you need to think about what kind of land value you would have. That being said, we know where to look on tax assessors' websites and looking at your appraisal. We have some general guidance to provide, and often your CPA will as well, just about land valuations. So.
Perfect. So let's kind of go back to Howard, what I kind of alluded to, and tax rates are obviously rising and we expect them to continue to rise right now. So is now when you would recommend doing these cost segregations?
Generally speaking, sort of like what you said before, and maybe I'll use a different analogy. You have to make hay when the sun shines. Is, take advantage of the rule now. You could always play around with, will rates go up? Will I make more money in the future? But one never really knows that. So I always suggest to do the cost segregations as soon as possible. And again, when you talk about the flow of funds, I use a relatively simple example. If the property's basis is $275,000, And I use that because standard depreciation is over 27 and a half years. Normally, you would get a $10,000 depreciation deduction. But if you could take 30 or 40% and depreciate it immediately, that would be about 100,000. And if your tax rate is around 20%, well, then you're saving about $20,000 in taxes. And again, that could be money in your pocket literally today, or certainly in the future. So, my advice is always just to do it now and don't play games with the future.
And then let's talk a little bit about these tax considerations. And Howard, I'll let you kind of handle this one. But what are the things that people need to keep in mind if they choose to move forward with the segregation study?
I think, again, the key is to know your tax situation. You don't want to assume that if I do this, I'll have X dollars in my pocket now or later or whatnot. You really need your tax advisor, your CPA, to go through everything and also weigh that against the cost of the study itself. Because if it's a small enough property, there's a certain break-even point where, yeah, you'll save this much money, but you're putting out a few $1,000s on the study, and it's just not worth it. Leah, you had the same situation. There were some low value properties, and it just wasn't worth it to do those. So it's very important to understand where the benefit kicks in. And again, depending on whether you're considered a real estate investor or not, or what your income is, or a mix of those things, it's very helpful to have someone tell you that, here's your situation, here's what the laws are, and here's exactly how you'll benefit. Again, everyone will benefit in some way, but your tax advisor can tell you how. The second thing, I'll say, and this sort of goes to what we've spoken about before, or should you use a CPA and do you need a CPA? And granted, my answer will probably be you need a CPA, but the cost segregation study is relatively easy as it is to understand where the savings are. The actual tax preparation is pretty difficult. I see one of the bullet points here is the accounting method change form 3115. That's not a TurboTax form. That's not something that you can just kind of figure out by looking at it. And then depending if you're doing the cost segregation on properties that you've had for several years and you've already been depreciating under the old method, and that's sort of where this accounting method change comes in, there's almost two factors to the cost segregation. There's what is the catch up? What is that difference on those older properties between what I could have been depreciating and I actually did, and I could take that now. And then there's the new properties, which just simply start out, from scratch. And it's like, okay, you're taking the 30% right up front. So it is relatively complicated. And I would suggest talking to a professional about what the effects are and what actually goes into it as far as getting that tax money into your pocket.
I'll tell you, one of the things that I believe in my own business, both on my real estate and my investing side and the rental company, is I would rather spend a little more and have a professional handle it for me than to handle it myself. Now, I also recognize not everybody's in that position, but what I would say is if you're already paying a CPA to handle your taxes and to review your situation, or an attorney to review whether you need this company or create companies and all those nuances and things that go into play with this, I definitely think it's worth having that conversation. I'm a big believer in having a model to follow and having a business plan. And so I strongly recommend anyone who's doing real estate investing, buying real estate, coming up with a portfolio. We give you a lot of the model to follow and we give you a lot of the contacts to use. But it's really important that you take that next step and you talk to people and talk to those specialists that can help you devise that model. Is that a conversation you have to have every year? Probably not. Is that something that upfront you should do so that you can come up with your entire plan and all the ways to maximize? A lot of people think when you buy a piece of real estate to rent out, it's just about the monthly cash flow. And a big point of all of these webinars that I do and the classes I teach and my radio shows and everything else is to tell you, no, there's so much more. It's not just cash flow. It's buying in a stable market so that you're not having to deal with the laws of non-tenant strong markets. The problem is if you have, say you buy a property in Chicago and you compare that with a property in Dallas, just by nature, you're going to have higher repair costs generally because the homes are older, and you're going to have higher vacancy costs because it's harder to get people out. It's harder to do make readies. It's harder to take deposits. But then you look at the fact that you want to buy in an appreciating market. So you buy in a market that where the value is not going up versus buying in a market where the value is going up. So you've got that equity capture and depreciation happening. You've got the depreciation on your taxes for the benefit of real estate. You've got the asset increase that gives you better availability to lending and portfolio lending at better pricing. There's so many ways to make money off one asset. And a lot of people kind of get stuck in just looking at the cash flow. So it's really important that you build that model and you build that team and you come up with what your business plan for your portfolio is going to be up front. So you get all the guidance and all the information. You want enough information to be dangerous because you don't always want to rely on thinking that you know everything going on just because you've read some articles or because you've listened to classes like this. There's so much information out there. And I'll tell you, a lot of it's not good. There's a lot of people who are out there educating and they're charging for it. And they're what I would call a false guru. There's people that charge that are great and there's people that charge that are awful. And then there's people that teach that don't know real estate. And so it's, you've got to be real careful where you get your information. So building that team and coming up with that business plan and looking at all the different things that you can be doing to maximize your returns is really important. And then if you're not doing it on a recurring basis, set some type of interval. Well, every 2 years, I'm going to have a 30-minute phone call with my CPA. Every 12 months, I'm going to have a 30-minute call with my attorney. As you build your portfolio, especially with a model like ours, where you're constantly 1031ing and doubling that portfolio, it gets big really quickly. I tell people all the time, if I were to look back 6 years or 5 years, I only had a handful of properties, and now I buy 10 a month. And so it can happen and you can get there and it's not unattainable. It's all about your model, how you follow it, and who you surround yourself with. And so just keep in mind, it's not just about cash flow. That's just one piece of the equation. I'll leave you with this on that kind of note. People don't realize your principal pay down equates to about a 2.5% to 3% return a year. So just on buying a property and paying a monthly mortgage where you're paying down that equity with that monthly principal payment, that right there is an almost 3% return. So a lot of people don't realize how many different places there are that you're making money in residential real estate. So just make sure you keep that in mind and you're building that team and building that model. I can't state that strong enough. Now, we've got a whole bunch of questions here, so let's just kind of jump into these.
Can I add one
Oh,
thing?
please. Absolutely.
Tax considerations on this page, just something to keep in mind. You generally want to hold these properties for at least 5 to 7 years because of suffering recapture tax. So if you're planning on buying these and selling them quickly, you generally don't want to do a cost segregation study. The caveat to that is the 1031 exchange rules. So if you're planning on buying and then exchanging, then the cost seg could make sense. Something you should be aware of though, that you only get bonus depreciation for 1031 exchanges on what we call the excess amount, essentially the new money spent on the property. So if you sell a $5 million property, exchange it for a $7 million property, it's really just that $2 million extra. This is just a high level overview, but only the $2 million extra is eligible for bonus depreciation. That's why it's generally recommended to be exchanging upward. I think Lee was essentially mentioning that earlier, like exchanging a property for a higher value property so that you're getting some money eligible for bonus depreciation. Just two things I want to throw in there as tax considerations.
Correct.
They're excellent points. Excellent points.
Absolutely. And so for those of you that follow our model and you're putting 20 to 25% down, you're selling at the point where you're turning 1 into 2, 2 into 4, or right now, potentially even 1 into 3 or 1 into 4 because of that leveraging ratio. And so it definitely makes sense. So I cost segregate and then I 1031, and that's the same model we teach to you. There are some people who believe in the cash payment method where you buy a property in cash, you never leverage it. If you then go to 1031 that property, you're not going to exponentially be able to grow with the same amount of cash. And let me explain what I mean by that. If you buy a $200,000 home in cash and it goes up to a value of $250,000, if you're leveraged on that property, you only have 20%, 25% down. You've appreciated another 25%, and so you're able to go and buy 2 properties with that appreciation. If you pay cash for that property, you're now worth $250,000, but $250,000 is not enough to go buy 2 homes. So that is why leveraging is key to our model, and that is why we talk a lot about different leveraging options and how it exponentially increases your return. because of course 2 properties instead of 1 means you've got 2 properties appreciating, assuming the market's appreciating, 2 properties cash flowing, 2 properties to depreciate. So there's a lot of benefits to leveraging. I do not ever preach, and you will not hear me preach, a cash purchase model. The only time I pay cash for a property is when that's the only way I can close it fast enough, and then I immediately go refinance it. And this is not an affordability issue, guys. If you have enough cash to pay cash for 1, go leverage it and buy 4. Or keep your cash and only buy 1 and leverage. And so leveraging is a tool, and it's very important to this process in our model as well. So let's talk about qualified improvement property. You kind of alluded to this earlier. Which one of you wants to kind of cover this one?
Yeah, I can discuss it. Yeah, so qualified improvement property has been around since 2016. Essentially, it's replaced qualified restaurant property, qualified leasehold improvements. So there were some other rules in prior years, but because the tax law changes, the only thing left now is qualified improvement property. And essentially now there was a tax correction that occurred in the CARES Act. For a while, it was 39 years with no bonus, but the CARES Act went back and corrected it. So even looking back, it has now become 15 years and eligible for 100% bonus depreciation. And qualified improvement property is currently eligible, it's moving forward. There's no expiration currently slated to expire qualified improvement property. And the idea is it's interior improvements to your space. So this picture here shows, maybe improvements that were done to a shell building. So the flooring and like the wall paneling and the lighting, any interior improvements that aren't structural in nature should be eligible for qualified improvement property. There's a few exclusions, but even HVAC systems inside the footprint of the building, plumbing systems, things that would normally be 39-year property, real property, are eligible to be slated as qualified improvement property and get currently 100% bonus depreciation on all those assets. So say you spend, $200,000 to improve your short-term residential rental property, like your vacation home that you're renting out, and 160 of that is interior improvements. It's not painting the exterior of the house or putting in new rooftop units, stuff done inside the house. Well, that would be $160,000 of immediate tax deductions currently, and then you'd still get the smaller deductions for the rest of the $40,000. So qualified improvement property is a great thing, especially for commercial and for short-term rental properties, but it's not eligible for long-term rental, not for residential rental properties depreciated over 27.5 years.
Perfect. And we really already kind of covered bonus depreciation, but Howard, I think there's probably a couple things on this you want to go over as well.
Let's see, rate phase down. We talked about it's available for used property. We also talked about that, sort of going backwards and recapturing some of that. There are some rules, though, as it mentions below. I think one of the most important things is no bonuses if the property is acquired from a related party. A lot of people think it's easier to get into the business by, buying another property that somebody else they know has, or if it's a controlled group, it's basically companies that are related to each other. And there are some other details, but again, I would say those other bullet points, it's sort of a case-by-case basis, and I don't know that I can make a blanket recommendation on them.
Yeah, again, this goes back to if you have a unique situation or you want to talk about your specific plan and goals, that's where these experts come into play. And we really kind of touched on this, but let's make sure we're crystal clear. So what if I 1031'd into a property, and what is happening right now with cost segregation? I know there was a lot of discussion about this, and for those of you on our mailing list, we actually sent out a flyer about this a few days ago, but Howard, kind of get us up to speed on what's happened.
I think here it's sort of what Winston touched on before. Again, if you 1031 into something, there won't be any recapture, which is really, really key, because you don't want to take a huge $100,000 or $500,000 depreciation deduction, and then the government says, okay, well, you didn't really use the property very much, essentially, and you sold it a year later. Now we want our money back, which is what they will do. that's something to take into consideration. And then again, the 1031 rules, as also Winston mentioned, it's something that's a little more up for debate about whether they pull back on the 1031s entirely or they change it or not. We're hopeful that they won't, but it's definitely something that we need to take into consideration as you're doing the 1031s to making sure they're still out there, because if they take them away, you're going to have to hold that property again, as Winston mentioned, for 5 to 7 years, just to make sure that the cost segregation remains worthwhile and there's no recapture.
Perfect. All right, let's tackle really the most important thing I'm sure that everybody's wondering, and that's what's the cost of the different options for this? And let's kind of keep that to single family. And then for those of you with larger projects, multifamily, et cetera, they'll probably price those on a one-up basis. So what is the price for your online estimator? And then for a full study for a single family residential home, what is that price? And then of course, also, if somebody has many properties, is there a bulk discount?
Yes, yeah. So it's around $400 for individual uses of the RCS software for houses below $500,000 in basis. So it could be a $700,000 home, but $200,000 of land, that sort of thing that gets them under the $500,000 of basis. So it's $400 per use. If you buy those in bulk, I think if it's over 10, there's a discount there. Maybe it's like 10 or 15% or so. The other thing you had asked about single family residents to do a full study. We will do, some people don't want to do the software themselves. They want to have somebody else do it, somebody that's done it, many times and knows what they're looking for. So often we'll do a study for maybe, instead of $400, we'll do it for you for $2,000, so that involves also maybe helping you think through the land value and just gives a little bit more attention and detail to that aspect of it. We also will, it's a case by case basis, it depends on how big the house is, but we will do fuller studies for more than that. Maybe it's $3,000, $4,000, where instead of using the software, we do like a real deep dive into it and give you the full KBKG report. So you're going to get more benefit, bang for your buck for that, essentially, doing that more detailed study, I'd say. And also, if it's residential rental property, if it's like apartments or something of a kind of higher basis amount, there's just a range of, it's a case by case basis, but it would be probably north of $5,000 to $10,000, depending on how large, how much time it's going to take us to do. So we do it based on calculating how much time we think it's going to take us to complete the study.
And for people, a huge chunk of our clients buy new construction, which are relatively simple. The online estimator is really quite sufficient for that, correct?
Yeah, again, if the basis amount is below a certain level, then yes, it can be used for new construction as well.
And then for second homes, there's no reason not to cost segregate those, or that you can't, so long as it is income producing, meaning that you have it as a VRBO or you're renting it out or using it for income, correct?
Howard also brought up the fact, thinking through whether or not you're a real estate professional, and Howard, you may want to speak to this, but there's some considerations, but you essentially can use those deductions eventually, even if they're passive activity.
That's right. Yeah, I mean, the answer to the question about the property itself is yes, of course you can, as long as it's income producing. But again, the tax benefit will be clearer if you are a materially participating, real estate investor, which generally is going to mean you're spending at least 15 hours a week outside of the pure investment portion. So actually managing the property and working out the repairs, and that actually includes if you're dealing with a property manager and you're working with a property manager. It's a little bit of a gray area, but I believe it also counts because you're actively managing the property, while you're working with the property manager. So again, it really depends on the individual situation as to whether they get that cash in pocket benefit or if it's just a future benefit.
Do you think that somebody who is doing education and webinars and all of that, does the education piece count towards that time requirement in your opinion?
I would say it does. I would say it does.
So, interesting segue. Does the use of a property manager affect the ability to do a cost segregation?
No.
I mean, generally speaking, no. Yeah, to me, the answer is obvious. That's why I paused. It is no.
That was an easy one. I gave you like, a home run hit right there.
Right.
And then this is another home run. Does the incentive become available to a new landlord even if the prior owner of the rental already used a cost segregation? That is a great question.
Yeah, it's all based on the amount of basis that particular person or entity spent. So it doesn't matter whether or not, you had a property, sold it, and then your friend buys it. He gets his own depreciation for that property. It will impact whether or not you pay recapture tax on the property, depending on when not depending, but on the fact that you've sold it. So, or unless you've done a 1031 exchange.
Yep. And I've got a couple pricing questions for multifamily projects. Guys, reach out to them directly. I've put Matthew, the point of contact's email on here for you, and he'll be the one you want to reach out to get pricing for those larger projects. Let's take a look, see if there's anything else. Lots of compliments for you too. So great job. And then tell us one more time, what is that URL link for the first time residential analysis?
Essentially, if you go to KBKG's website, I think you had it on there, KBKG.
I do. I can go back to that real quick. Let's see where that was. It's a few slides back.
But essentially, if you go to kbkg.com, yeah, and look up
Right
software.
I think it's right on the homepage. Yeah.
Yeah. And then last question. I was told that if you have a full-time W-2 job, you cannot qualify to be a real estate investor and realize all the cost segregation benefits unless you can prove you also spend an equal amount of time on real estate related activities. This sounds different than the 15-hour requirement you mentioned.
It's actually 15 hours and 50%. That's a very good point. So that's what it actually says. It has to be at least 15 hours, or basically 750 hours a year, plus it has to be 50% of your income producing time. Regardless of how much income comes from one source or the other, it does have to be 50% of the time that you spend in income producing activities.
I've seen a lot of people where one spouse works and one spouse stays home, or one spouse is retired, or one spouse just doesn't work. And so there's ways to make it work in many cases. So of course, that's a great question for your CPA based on your specific situation.
Right, and the hours that your spouse does do, or does participate in the real estate activity does actually get included. It's sort of like a family deal.
Perfect. Well, gentlemen, looks like I might have had one last one pop up. Nope, that was just a thank you. So both of you did fantastic as always. Again, I can't thank you enough for joining me today. I know that, again, you're both busy and we really do appreciate you taking time out of your day to come here. And if anybody has any follow-up questions, you can feel free to email Matthew or Howard, or of course you can email our investment team as well. Otherwise, thank you again. I hope everyone has a fantastic rest of your week, and we'll look forward to seeing you in a couple of weeks for our next class. Thanks so much.
Thanks again, Leah, for the opportunity.
Yep, thank you.